This year's prize in economic sciences offers empirical findings about the price movements of assets such as stocks and bonds. So announced the Nobel Committee as they awarded the 2013 Nobel Prize in Economic Sciences to Professors Eugene Fama, Lars Hansen, and Robert Shiller. At first blush, it's a challenge to reconcile how the opposing viewpoints of Fama and Shiller could be awarded the same prize at the same time. Fama's contributions to modern finance are pervasive, so much so that he is known as the father of modern finance. Fama's share of the award is a result of his 1960s work establishing that short-term stock prices are very hard to predict. He demonstrated how prices quickly reflect all known information, making it virtually impossible to identify mispricings in securities and exploit them for profit. Fama's findings assert that markets are rational and that the current price is the best estimate of a fair price. An investor who ascribes to rational and efficient markets theory would accept the futility of attempting to beat the market and simply buy the market in the form of index funds. Fama's findings actually sparked the birth of index funds, giving rise to a movement that has exploded over the last 4 decades when Fama's findings resulted in the packaging of products that have been sold to investors the world over. For Shiller's part, he sits directly opposite from Fama on the side of market efficiency, arguing that irrational investor behavior creates securities mispricings that can be identified through rigorous analysis and exploited for profit. Shiller's research in the 1970s kicked off an area of study called behavioral finance. It's an intriguing proposition, one that begs analysis into the real-life implications and profit opportunities presented by market forecasts that may not be perfectly rational. If Fama's solution to investing is to accept that the market knows all that is knowable and that prices reflect all information, Shiller would contend that irrational investor behavior can cause the market to get it wrong, and a cool-handed, savvy investor can profit from those mistakes or mispricings, paving the way for an esoteric form of active management that focuses on exploiting investor behavior and its impact on markets. A basic, if not overly simplistic, explanation of behavioral finance would be when a fund manager views pessimism as a buy sign and optimism as a sell sign. The idea here is that investors are, as a group, overly pessimistic or optimistic, leaving room for mispricings from irrational behavior. Do investor emotions play into prices? Of course they do. But it is far too simplistic to think that one can outsmart the market irrespective of what precipitated the trade in the first place. And I think here that Rex Sinquefield, one of the first to bring index funds to the market, perhaps says it best. Rex tells us, "Nobody knows precisely what causes markets to price securities and assets the way it does. Their opinions are factored in, but so are the opinions of 6 billion other people. And so the market is the only thing that possesses the implications of all the information and insight and preferences and actions of all 6 billion people in the world." So you can think of the system of market prices as a vast processing machine that takes all of this information and brings it together. The fundamental question for an investor should be this: whether markets are rational or irrational, what investment strategy delivers the highest probability of achieving investment success? Defined only in terms of net of fees, risk-adjusted return. And it turns out that while the 2 Nobel laureates we've discussed agree on little in terms of fair prices, they both agree the best way to capitalize on the returns offered by the market is through index funds. And despite Shiller's commitment to market irrationality, he's a fan of Fama's efficient market research portfolios, which are brought to market by Dimensional Fund Advisors, or DFA. In a recent New York Times article, Shiller said, "I can even recommend that people might consider investing in DFA." Well, Professor, so can we. And by the way, we do it all day long.